All right, so a very warm welcome. Thank you very much for attending, and yeah, thank you very much for your time. I'm looking forward to navigating this very important topic, geopolitics, that we as traders must account for. So my name is Aaron Hill, and as you can see here, I'm the Chief Market Analyst at FP Markets. Now, I must be clear from the outset of this presentation that I did not graduate in politics, but I am aware of what I need to. I am aware of what components I need to understand in order to trade. I also do not claim to be an economist, although I have completed the first year of an economics degree. However, at the heart of things, as a trader, the good thing is to succeed as a trader, you do not need to be an economist, and you do not need to be well versed in politics. As I've mentioned before in a number of presentations that I've given, some of the best traders that I know and have had the fortune to work with had simply a basic education, but what they had was an insatiable appetite to learn about trading and all of the components that complement this field. Okay, so I guess that I'm coming across loud and clear and all the visuals are good. There's no comments in the box here, so the chat box here, so I guess we are good to go. Look, a brief disclaimer here, guys. I will not bore you. I will not recite all of this text, but suffice it to say, the following presentation is educational advice. It is not that it does not constitute. Sorry, it's educational in nature, and it does not constitute investment advice. Now, the objectives of this presentation is, of course, understanding the geopolitical landscape. How geopolitics and macroeconomics interact, and of course strategies for approaching a geopolitics. And we'll round things off with a Q&A at the end of the session. It may surprise you that there are a lot of traders that do not understand what geopolitics represents. So what is geopolitics? It is essentially a way of assessing politics and international relationships. It is the assessment of geography, and how it influences politics and international relationships. State and non-state actors. Now, this is not something you've likely heard or is widely used in the financial media, but it will help, especially for anyone new to geopolitics, it will help enhance your understanding of, shall we say, the players within the geopolitical space. Now, a state actor is someone that works within the government. So you can think of the president, so the president of the US, the prime minister of the UK, for example, and other world leaders. They are working on behalf of, as you can guess, the state. So we have, and then we have non-state actors, which, does not work directly within the government. So we can think of multinational companies, huge charities, and even influential individuals. And you can think of Elon Musk as an influential individuals that can have an effect on the geopolitical landscape. Geopolitical risk is something I'm willing to bet that most of you have heard of, but for those new to this field may not understand. So, as its name suggests, geopolitical risk is the risk associated with the tensions and or actions that affect the normal, traditional, peaceful international business and interactions. So this can range from things such as, so the geopolitical risk can range from things such as change in policy, disasters, a natural disaster, terrorism, or even acts of war. All of these factors can vastly impact the way that in which countries interact with each other. And as an extension to this, it can affect the way that we trade the financial markets. Now, for me personally, I always factor in the geopolitical risk that's currently present. And you'll find that as you become more versed with macroeconomics, you'll find that the geopolitical space, especially now, often forms one of the major themes in the markets. So to trade, you need to understand that there are narratives, and from the narratives, you'll go down to the macroeconomic indicators. Then from there, you'll base your form trading ideas. I'll go over that a little bit in the presentation. So an increase in geopolitical risk may alter economic conditions. So that could influence things like GDP, price pressures, inflation, or of course unemployment, and this can trigger recessions and expansions within an economy. Again, we'll touch on this shortly. Now, one thing I do want to add here is that how does one assess geopolitical risk? I know for me personally, I do not use any indicators or anything like that. I listen to the financial news media and get my narratives from what's going on in the market. But there are some indicators out there. So we have things like geopolitical risk indices. As you can imagine, look, it's a complex task because geopolitics is not something directly observable and is influenced by a multitude of interconnected factors. But look, geopolitical risk indices they aim to quantify geopolitical tension by analyzing the frequency and sentiment of news articles related to geopolitical events, and this can range from war, terrorism, political tensions, and things like that, military buildups, and things like that. You may also find that some traders look at things like sovereign debt spreads. This method often compares the yield on sovereign bonds of politically less stable of a politically less stable country with that of one of a highly stable country. So, for instance, the US for US Treasuries. Now, this spread reflects the additional risk investors perceive in holding bonds of a less stable nation, which can include geopolitical risk. Now, cooperative and non-cooperative countries. Now, I'm sure it will not take too much to work out what this refers to. Simply, a cooperative country is one which harmonizes well with other countries, and that includes things like tariffs and usually the free movement of people. Now, a non-cooperative country is one which imposes arbitrary rules, which can lead to things such as restricted movement of goods and services, as well as people. So the motivations behind a country operating in a cooperative manner would be due to things like national security and defense, as well as other things like economic interests, as well as resources such as energy and food through means of trade. Let's be clear here: geopolitical factors play a vital role in shaping how a country approaches things like national security. Now, we can also think about it like this. When a country is dependent on resources, so food or energy, and they will almost always need to adopt a cooperative stance in order to maintain their standard of living within their country. On the other hand, a country rich with resources or a considerable economic advantage, think of the US, for example, can simply leverage this aspect to influence international dynamics more effectively in their favor. Think of the US again. And let's be frank, again, we have seen this under the Trump tariff regime. which is ongoing as we speak. Now, globalization is an economic and represents an economic and financial cooperation, and largely features corporations. So those are the non-state actors that we briefly touched on in the previous slide. Now, I thought this was really an interesting chart here, and could really help shape things for us. As you can see, this is the global trade as a percentage of GDP. Now, as you can see, from around 2008, we have seen headwinds within the global trade. And this, of course, was affected by the 2008 financial crisis, where we saw a rise in nationalism as countries showed decreased appetite for imported goods. What does this chart tell us? It tells us that we have a high integration at we're just under 60%, so we're around 57%. 57% of GDP. This tells us that countries are economically integrated. Supply chains are globally interconnected. Economic shocks can spread across the borders, and trade disruptions. So think of these tariffs that are ongoing right now can have outsized economic impacts. I mean, look at right now, we have Trump's tariffs are set to have an inflationary impact on the US, right? And it's set to have a disinflationary impact outside of the US, and is set to weigh on global growth. So hence trade disruptions can, so a high integration of global trade can have outsized economic impacts. So why does it matter for us? So the higher ratios, nearly 60% here, can mean there are more sensitivity to trade policy changes. Central banks also have to consider this, the global trade flows, when assessing monetary policy. Currency movements, so FX movements, can have bigger economic impacts. So when a currency rises, that tends to see exports increase and imports decrease, and things like that. So the bottom line here is that at nearly 60%, the world economy is incredibly interconnected, making trade policy and global economic conditions important for the financial markets and, of course, economic stability. Now, why the globalization? Why is it important, and why are economic actors motivated to trade globally? Let's think about a basic example of a company and how they can increase profit. Now, correct me if I'm wrong, but this is largely down to two things. They can either increase sales of their goods or services, i.e. find new customers, or they can reduce costs of production. Now, in order to seek out new customers, they may have to search beyond the borders of their country, which may require significant investment to the point of opening stores in different countries, opening factories, and things like that. Now, the company will also look to hire local staff abroad, having boots on the ground who understands the local traditions and customs, for example. Look, to reduce costs, it's the same thing. This may involve seeking lower tax operating countries, seek supply chain efficiencies, and reduce labor costs. As I'm sure you know, while seeking new customers in new countries and reducing costs can benefit these companies, but there's always an offsetting cost to be conscious of. It does not mean an improvement for everyone. So a basic example of this is say a company hires new staff abroad. What do you think will happen to the staff within the home country? That will lead to job losses, because if they can hire 3 new staff abroad for lack of a better word, for the price of 1 in their home country, it doesn't take a lot to work out. Another example might be environmental issues due to the lack of governmental oversight in foreign destinations. This can have a real effect on the environment. Look, the main point is that globalization has a lot of benefits for companies, but it also has drawbacks. Now, deglobalization. Now, this is an important topic, I feel, and this refers to the reduction of the interdependence and integration between nations, essentially unwinding the globalization processes. So what does deglobalization look like? Trade fragmentation, moving from global supply chains to more regional and domestic ones. Tariff increases, again, we can look at Mr. Trump for that. Tariff increases, countries raising, so the US raising trade barriers to protect domestic industries. Investment restrictions, limiting foreign direct investment, especially in strategic sectors. So this is what deglobalization looks like. We have what I believe, as I've just mentioned, we have what I believe a good example of this with Trump's America First policies, and this indeed contributes to a broader shift, from I'm just trying to think of the best word, a broader shift away from traditional globalization. Though with Trump and his tariffs, the picture is a lot more complex rather than a complete reversal from globalization to deglobalization. So look, just to be clear, I have no political affiliation here. These America First policies aren't reversing globalization entirely, but they are fundamentally reshaping it. We're moving from a model of maximum efficiency through global integration to one prioritizing resilience, security, and domestic interests, even at the cost of some economic efficiency. All right, so the interplay of geopolitics and macroeconomics. This is where things get quite interesting, in my opinion. Now, geopolitics, such as conflicts, trade tensions, and political instability, can create uncertainty. It can also disrupt supply chains and lead to fluctuations in commodity prices. We'll touch on that very, very shortly. Ultimately, and this ultimately affects economic growth. It can also affect inflation and, by extension, the financial markets. So macroeconomic factors like inflation, like economic growth, inflation, and interest rates can also influence the geopolitical dynamics. So it's a bit of a each affects each other, if that makes sense. So geopolitics affects macroeconomics and vice versa. So a good way to understand this really is to take account of those global drivers. I've been over this in my previous webinar, I believe. So the global drivers are global growth, commodity prices, risk appetite and risk aversion, and geopolitics. And I find that the market does switch between global drivers and domestic drivers. I'll go over that shortly. So when global growth is robust, you'll see exports increase from the likes of China, and when global growth is softening, exports tend to lessen. So global growth, which leads to obviously a decline in global growth. Now, this can have a direct impact on commodity prices. So when you see, so this is why you'll find that there are some currencies that are referred to as risk-sensitive currencies or risk-on currencies. I'll go over that shortly, but that is because of their sensitivity to the global growth cycle. So when global growth is expanding, demand for commodities like iron ore, which is one of the largest exports out of Australia, is increased, and thereby the prices of that commodity are bid higher, and as they help drive growth. Risk appetite and risk aversion. Now these concepts are interesting as they help explain investor behavior. During periods of market optimism, risk appetite tends to increase and risk aversion decreases, right? So investors in a risk-on environment, investors chase those higher yielding but riskier assets. During times of market stress, or the opposite occurs. So risk appetite declines and risk aversion rises. And this leads to what's known as a flight to safety or a flight to quality, I might add, where investors move money into perceived safer assets like government bonds or cash markets. So what I mean by cash markets are money markets that deal in short-term debt instruments such as treasury bills, um, a commercial paper and things like that. And these usually mature within 1 year. Now, fluctuations in global risk appetite and risk aversion can often move the FX market, as I just mentioned, and this can trigger moves into currencies with higher risk sensitivity, like the Aussie dollar, like the New Zealand dollar, and like the Canadian dollar. So the Australian dollar is one of the most widely mentioned risk-on currencies, and this is because of its due to Australia's commodity commodity exports, iron ore and coal, for example, and historically they have higher interest rates for carry trades. And what you'll find is the Australian dollar tends to rise when global growth expectations are strong. The same for the New Zealand dollar. Similar to the Aussie dollar, it benefits from commodity exposure from dairy and agriculture and typically higher yields. Canadian dollar, of course, benefits is heavily tied to the price of oil. And tends to strengthen when global growth and risk appetite increase. Now, during risk-off periods, you'll find that these risk-on currencies tend to decrease and investors flee into more safe haven currencies. So think of the dollar, the US dollar, Japanese yen, and the Swiss franc. So, and then we finally have geopolitics. Geopolitics directly influences risk appetite and risk aversion, and can indirectly influence global growth, which itself, as I'm sure you will know, can directly influence a currency's trade balance and capital flows, and of course domestic growth. Now, these are the domestic drivers. So at the top of the pile, we have monetary policy. Below that, we have the macroeconomic data. These are the big three, guys: inflation, unemployment, and growth. If you're learning about macroeconomics, these are the first three economic indicators I would strongly advise you to become accustomed to. So if you're focusing on the US, look at CPI, look at PPI, look at the PCE data. If you're focusing on the UK, look at the CPI data and things like that, and understand what inflation means, understand what disinflation means, understand what deflation means, unemployment, understand that look at the understand what revisions mean within the jobs report. So you might recall Friday's US July jobs payroll data. That was insane. The trade out of that move was insane. I haven't seen that for a while now because of what's been going on with Trump's tariffs, like clouding the issue. But this is the first time I've seen in a long time that we've seen data move with such velocity, with such volatility, and enabled us to trade out of that event. So as you probably recall, I'm not sure why my camera's off, guys. I'm not sure. I haven't touched anything, so I assume you can all hear me still. So I will continue. So US July payrolls is I think it's averaging like 35,000 now. This is insanely lower than what it was before, and opened up the door to a strong downside move in the dollar, which was a tradable move, guys. And this is something that I wholeheartedly recommend you to understand. Inflation, unemployment, and growth. Capital flows and trade balance are another key factor that you should understand. Now, monetary policy is generally one of the most important domestic drivers of a currency's value, but whether it's definitively the number one depends on the time frame and the economic context. Guys, I just want to confirm that you're still hearing me, guys, because I'll be sitting here talking to myself otherwise. If you can just throw a yes in the chat group that you are still hearing me, because my camera has turned off for some strange reason. Just bear with me. I apologize for this. Okay. All right. So apologies for that. So why monetary policy is extremely important. So at the top of the pile, of course, we have those interest rate differentials. Um, this is a dominant factor. So higher interest rates typically attract foreign capital seeking better returns, strengthening the currency. Central bank policy rates directly influence these differentials and drive huge capital flows through what's known as carry trades. So if a central bank, so look at the US, so their rate is around between 4.25% and 4.5%, much to the displeasure of Donald Trump. It's quite high. You have the ECB's deposit rate, that's at 2%. So these are the interest rate differentials at play here. We also have forward guidance and expectations. Now, forward guidance is incredibly important for us as traders. Markets react not just to the current rates, because you'll see on a number of occasions, look at the Fed, they've held rates for 5 consecutive meetings on hold. So it's not just the interest rate adjustments, it's what is expected for future policy. And this is what forward guidance gives you. It also gives you guidance on what economic indicators to be aware of. So right now, inflation is a key one for the Fed, and of course, the labor market is a very key indicator right now. So this is something we need to watch for ahead of September's meeting. We have one more inflation report. Two more inflation reports and one more jobs report ahead of the September meeting. So this is what you need to be aware of in for the domestic drivers. Now, in terms of the macroeconomic data, I think of this as like a pyramid. So at the top of the pyramid for domestic drivers, we have the monetary policy. Then further down, we have economic data. So we can start basing our trades around the economic data. Strong GDP growth, employment, and productivity can, of course, drive currency strength independently of monetary policy. But these best trades do come into effect when they align with the central bank's bias. So, for instance, we all know that the Fed is looking to cut rates. I'm just going to give you an example here. And with July's payrolls number coming in markedly lower, which saw, as I'm sure you're all aware, saw the BLS chief fired by Donald Trump on the back of this, claiming that the data was rigged. I find this ironic, to be honest, from Trump regarding him firing the BLS chief, because she's essentially done what he wanted, what he wants, because now the markets are pricing in a September rate cut. Fully pricing in a September rate cut the last time I looked. And this is what he wants. He wants lower rates, but yet he's fired the BLS chief amid, as far as I can see, that they're baseless claims. And it's not a good look for the credibility of the for economic data, and makes our job as traders, especially those that trade news, all the more harder. We have capital flows and trade balance. So trade and the current account. So countries with large trade surpluses or deficits can see currency effects that can dwarf monetary policy impacts. But again, guys, it's a pyramid. We always look at the monetary policy. We start from there, then we work our way down to the economic data. Then we work our way down, or I do anyway, I'll work my way down to the technical landscape for that all-important entry. So ultimately, macroeconomics and geopolitics are connected. There's no two ways about it. If we understand the narratives are usually to do with geopolitics as well. So if we understand the narratives in the market, understand the central bank's bias, which usually forms the longer term trend within a currency, we can then look to align, as I've said, we can then look to align our trading around economic data. As I said, that Friday's payrolls data was a clear-cut opportunity short the pound, short US Treasury yields, and short stocks as well. I wasn't keen on the stock market. I was more keen on the dollar. But look, with this, we have we're in alignment, right? We have the central bank's bias looking to pivot dovishly, and we also have the economic data showing that they can adopt a dovish stance and lower rates. And the geopolitics around that tariff rates is, it's in line. All three are in line there to take advantage of this information. So this is certainly something to be aware of, and something to consider when you do look at how to formulate trading decisions. Now, we've pretty much already covered this, but macroeconomics and affects geopolitics and vice versa, guys. So I'm just trying to think of more examples for you. Look, a strong economy with low unemployment and stable inflation tends to bolster the incumbent government's position, while poor economic performance can lead to political instability and unrest. This is an example of where economic performance and political stability converge. So a country's economic policy, such as trade agreements and sanctions, can also be used as tools of geopolitical influence. Just another example there for you of how macroeconomics and geopolitics merge. Look, the Russian-Ukraine war, this war is another example of how the economic, the geopolitics merge with economics. So this war, this ongoing war, has significantly impacted global energy markets. I will touch on the oil market very shortly. And what this did was disrupted supply chains. It contributed to rising inflation. And it's demonstrated the direct link between geopolitical conflict and macroeconomic outcomes. So strategies for navigating geopolitical uncertainty. Now, how do we go about that? Now, personally, for me, formulating trading ideas primarily around geopolitics continues to be challenging for me, and really just too uncertain. I would never initiate a trade based purely on a geopolitical play. I have done it in the past. Some I've won, some I've not, some I've lost, and I've been burnt pretty badly. But hats off to those guys and girls that can that can trade based on geopolitical uncertainty. It's very difficult for me to do. As I said, it's definitely not impossible. And especially, I just find it easier when I complement my trading ideas with the macroeconomic landscape and the technical picture. So the first piece of advice I will give you for navigating geopolitical uncertainty, and this goes for, and this really goes for any type of trading or investing, is risk management. I've mentioned this before in previous webinars. As traders, we are risk managers first and foremost. There's no getting away from that. I know we all focus on the charts. I know we all want to understand what's happening in the economy to try and take advantage of this in the financial markets. But really, we are risk managers. We need to focus on that first and foremost. At a basic level, you need to understand position sizing. And that is critical. Even if you use a calculator, make sure you use that calculator. Make sure you understand what you are doing with position sizing. And if there's geopolitical risk, if there's heightened geopolitical risk, be sure to reduce your position size to adjust for that volatility and unexpected gaps, especially if you're holding positions over the weekend or overnight. This can really lead to some rather nasty losses or surprising gains. But as I said, we're risk managers first and foremost. You stop losses, guys, more. And with heightened geopolitical uncertainty, you stop losses more conservatively, as normal technical level. I say normal, technical levels often fail during crisis periods. If you're looking at this from more of a portfolio management perspective, now I'm sure I don't need to tell you this, but you really want to spread risk across different asset classes like currencies and geographic markets. When one region faces uncertainty, others may benefit from capital flight. So you should include things, safe haven assets like gold, government bonds, stable safe haven currencies such as the Swiss franc and the Japanese yen, for example. Now, I just want to spin things over to the gold chart. Bear with me, guys. We go. So there are some no-brainer trades amid geopolitical risk, and the gold trade has long been one of the best performing hedges against geopolitical uncertainty. Gold has risen significantly during periods of geopolitical uncertainty and, of course, Trump's tariff policies. Gold has risen, I think it was, the last time I checked, it was 28% this year, so far this year. And this follows, I'm just trying to check, 24%. I think, sorry, 27% in 2024. The gains in gold are just insane. The metal has hit more record highs than I care to even note. And this was bolstered in part to tariff fears, guys. The connection between Trump's tariffs and gold's performance is relatively clear. Fears of trade wars and geopolitical uncertainty appear to have really bolstered gold price. I mean, look at the price here. This is the monthly chart on the left here. It's almost parabolic, the move to the upside, and has been an incredibly good performer. One thing I will say from a technical standpoint, though, is we are at this critical area of RSI resistance here, and every time we've reached this level, look at this on here, we have the every time we've reached this area of oversold resistance, we have seen a pullback form in gold, and we are getting that right now. We are getting a meager pullback, but whether this is it, just a breather before we continue higher, is yet to be seen. But this is certainly something I am watching closely. Longer term, we are oversold, considerably oversold, technically speaking, from the according to the RSI. So what gold's doing here is performing as a traditional safe haven asset, and it's during those uncertain times. So you'll often see gold rally as well when amid natural disaster, when we have natural disasters or war breaks out, for example. Aside from the sad and unfortunate human loss, of course, it can also trigger a depreciation in the home currency of that country. You saw this in Russia when Russia invaded Ukraine. The Russian ruble fell dramatically, and the price of oil rose. Talking of oil, I just want to spin across to this chart. This is suddenly something I would have forgot this otherwise. So when Russia invaded Ukraine, oil prices actually surged. I think it was from here to the highs seen in March of 2022. As you can see, 65%. That's to the highs. I think it was around 50% to the close here. And that's in March of 2022, from February of 2022 when Russia actually invaded. And this marked one of the most significant energy price shocks in recent history. As you can see, the price rise was substantial, and it really opened the door to, again, aside from the unfortunate human loss here, and this really opened the door to a potential trade in going long in oil and long in gold on the back of these moves. Because look, Russia plays a significant role as a global oil supplier, and that meant the invasion of Ukraine from Russia created immediate supply concerns, even though energy exports were initially subject to sanctions on Russia. The market still reacted, pushed higher. So these are opportunities that you need to be aware of, and you need to stay informed when you're. You need to stay informed anyway. As a trader, you need to be aware of everything. You need to be aware of what the central banks are doing. For the currencies you're trading, look, what I found that most easiest when I first began looking at macroeconomics, I found sticking to one country and currency. So for instance, the US dollar, understand the Federal Reserve, understand it's a 12-member voting committee. Then from there, understand what the narratives are. Right now, we have US President Trump. He's controlling most of the themes right now. We also have the debt issue going on in the US. There's a number of themes playing out, but Trump is still at the top of the pile. We also have the issue of a Fed shadow chair, right? Trump, alongside firing the BLS chief, he's now looking at not imposing, he's looking at announcing a Fed chair because there's a Fed governor, Adriana Krugler, I think I pronounced her name right, is resigning earlier than her term. Her term was supposed to expire January, I believe, next year, but she's resigning early. So there's a spot open. I think Trump's going to fill that with the next Fed chair candidate. But this really opens the door to a number of challenges from a trader's perspective because we now have two influential voices because the markets are going to think, okay, this is the next Fed chair. Do we listen to him or do we listen to the current Fed chair, which is Jerome Powell? So it really creates this dynamic and fluid situation that we need to be aware of. The point is you need to be aware of what's going on. So from the central bank, you need to know inflation. So inflation has ticked higher. We know unemployment is ticked higher as well. We know jobs is down in the US. Job growth is the average pace of jobs growth is down in the US. We also know growth is expected to, I think it rose. My memory, it's been a long day, but I think it was up 3% off the top of my head. I know we're coming off a contraction of 0.5%, but yeah, so you need to understand what's going on in the US economy, and then you can move down to formulating trading ideas based off of that. Sorry, I diverged a touch there. I didn't mean to. So look, geopolitical I'm just trying to think of the best way. So less vulnerable assets. So moving away from currencies and things. So precious metals, again, look, they're the less vulnerable assets when geopolitical risks increase. So gold and silver are traditional safe haven assets and tend to perform well, as we've seen, during periods of uncertainty. Government bonds, high quality government bonds, especially from those stable currencies, can offer security and steady returns. We also have defense stocks, right? Going to the stock market, defense stocks, companies in the defense sector can benefit from increased government spending on military and defense in times of war, geopolitical risk. So this could be stocks that you might want to look at. Utility stocks, the consumer, I'm not a stock investor, consumer discretionary, not consumer staples, there we go. Provide essential services, right? And often have really stable earnings, making them less volatile and the ideal investment during periods of economic uncertainty. So they're the less vulnerable assets. So assets that so this is really what I wanted to get across. So I hope I've given you something to think about here. Are there any questions regarding there we go. Are there any questions, guys, regarding the presentation or anything I've mentioned? Nope. Okay. All right. So you're very quiet, guys. If there's no questions, I will wrap things up here. But yes, so the idea is to keep a pulse on the ever-changing landscape of, what's going on, especially with Trump. You need to be aware of what he's doing. As annoying as he can be sometimes, you need to understand what he's doing, what he's saying. Because look, for an example, the Fed chair Jerome Powell, if they put someone in the Fed, Krugler's position, this can really create some issues going forward for us as traders. Who do we listen to? Do we listen to the Fed chair Jerome Powell, who's out next year, or do we listen to the next guy in the shall we say hot seat? For the next Fed chair position? It's very difficult, but you need to be aware of what's going on because you can be caught offside by not understanding the geopolitical dynamics that are present. Okay, so there are no questions, guys. I do hope this presentation